It's my great pleasure to welcome you here to this seminar today, which is on a very interesting issue of the interbank market. And adding to the previous sessions that have explored interbank developments in Uganda and Kenya. And so today we are delighted to have a special case, the start of the market with respect to Malawi. As you may have noted from the joint activity we did recently last month on the 15th with the ODI London and with the African Development Bank, making finance work for Africa, where we covered developments on the interbank market in Africa, the first ever seminal studies. Going back the work we started with the Chris Green at Loughborough and Yebai at Nottingham, now in Liverpool, Jiantong University in China. So that's where sparked off this work on interbank markets. The seminal the first ever study we did on Kenya started off this interest, and now we are exploring, looking into at least the cross-border issue. But for today, we look at the market in Malawi, and we are fortunate to have the main speaker, a person that has distinguished herself in this particular research, Esmie Kanyumbu. Esmie Kanyumbu is an accomplished researcher and a policymaker, and has been a rising star for a number of years. And she comes in as a researcher, as a policymaker who is head of a department at the Reserve Bank of Malawi, as a researcher who has been very active in the African Economic Research Consortium, Group C, where we meet, and also with Chris Green and myself and Esmie, and has indeed accomplished two full-fledged research projects, both in the interbank market, and the third project on financing SMEs within the African Economic Research Consortium. At the same time, she's pursuing a doctoral program at Loughborough University. So, Esmie, thank you very much for being able to join us today to present this work. But it's also a great pleasure to introduce a couple of people who will be commenting on this work. I think we still wait for Dr. Michael Atingi to join us. And I will be introducing Michael, when he does. But briefly, Dr. Michael Atingi is the Deputy Governor of Bank of Uganda. We'll also be receiving some comments from a number of people who are looking at the interbank market, especially in Africa, by Dr. Thomas Gwile, who is from Bank of Uganda, but also attached to the COMESA Monetary Institute based in Nairobi. And also comments from one of the other rising stars, Anosi Ikimaro, who is pursuing a PhD on interbank markets based at SOAS University of London. And I'm sure we'll get some other commentators to join us, given the interest in this particular area. So for housekeeping, let me mention that please mute your mics, and if it helps your video, if it does help in terms of the reception, I would encourage you to post your comments and observations in the chat room, and also get an opportunity to ask questions, make observations, suggest further ideas, and that we can do when you raise your hand at the end of the presentation, and we keep on picking comments and questions and discussing these issues. Okay, so let me now ask Esmie to step forward and start the presentation, and you can share your discussion as we go. Thank you.
Yeah, thank you so much, Chair, Professor Murinde, and welcome everyone to this presentation. Indeed, I'm Esmie Kanyumbu I'm wearing two hats, that of a central banker and that of a researcher. And I think I'll benefit from both sides, from the researchers, experienced researchers in the house, and also from my central bankers. I'm not yet the head of department, but I head a section that looks at market development. And one of the things that we look into is the interbank markets.
Yeah, so, thank you for that correction, Esmie. Yes, it's a unit here. Yeah.
Yeah, so today I'll be presenting on the role of interbank markets in monetary policy transmission in the context of Malawi. I'll quickly talk about what interbank markets are and also discuss the literature that has motivated this study. And then I'll talk about the objective of the study and the data and methodology and the preliminary results that we have at the moment and preliminary conclusion and implications. So what are interbank markets? These are markets where banks lend and borrow funds from each other for the sake of meeting their daily liquidity needs, usually short-term liquidity needs. And interbank markets are one of the most important markets for banks within their intermediation role. This is because interbank markets provide one of the most important funding channels for banks. And these markets also facilitate smooth functioning of the financial system in such a way that or we can say most of the liquidity gaps are closed before the central bank takes action. You may recall that the 2007-2008 financial crisis is attributed to failure of interbank markets to distribute liquidity within the financial system. So these markets are really important. And in addition to that, interbank markets also act as a transmission mechanism for monetary policy. In the sense that signals through the interest rate in the interbank market provide an effective way of discovering prices in other money markets. This is usually where the overnight rate, which acts as which is the rate on the shortest end of the yield curve, is determined. So I usually say that interbank markets are unique. They are in a class of themselves because unlike other markets, loans in the interbank markets are both collateralized and uncollateralized. And because of this aspect, interbank markets are associated with trust, and that trading between banks works with trust, is based on trust. And that has two implications. One is that there is peer monitoring and strong discipline mechanism in these markets. And the second one is these markets are associated with strong relationships. So over time, banks form relationships within this market because trading depends on trust. And this has an implication in that the liquidity management efforts of the central bank may be limited in influencing rates in this market. Since there is this peer monitoring and strong discipline mechanism and trading relying so much on strong relationships, that means there's a limit to what the central bank can do. If the central bank, say, withdraws liquidity or injects liquidity, they may not achieve the intended levels of rates because of such interbank behavior. So what is in the existing literature? Most of the literature on the subject talks about the existence of market discipline and determinants of access as well as pricing of liquidity. For example, King 2008 found that riskier banks pay more than safe banks for both unsecured and secured interbank loans. And these riskier banks are less likely to use interbank loans as a source of liquidity. This is also supported by Fufin 2001, who established that interbank borrowing rates reflect the riskiness of borrowing banks. That is in the US federal funds market. And other authors talked about relationships in this market, that relationship play a crucial role. For example, in the Portuguese interbank market. So determination of both access and price of funds depends also on relationships. And for authors like Samiento 2016, found presence of market discipline among participants of the Colombian interbank market. And they also talked about the role of liquidity risk and liquidity hoarding in explaining pricing of interbank loans. Yeah, for Green, who is also in the house, Green, Murinde, and colleagues, they say they found that banks with increased capital buffers enjoy lower costs for borrowing in the Kenyan interbank market. And for Malawi, myself and Triongo also found that riskier banks borrow less from the interbank market and also pay higher prices comparing to less risky banks. I know there's some also work for Uganda by Dr. Thomas Wire, who is also in the house, and another piece of work in Zambia by Chipiri and friends and colleagues. I think the stories points towards the same issue of market discipline. And departing from that, there are other studies that talk a bit different from the determination of price and access. For example, Acharya et al. 2012, they studied the role played by liquidity rationing, and they found that surplus liquid banks exert market power by rationing liquidity to deficit banks. And Ding and von Hagen, 2019, talked about the impact of interbank borrowing on bank risk and found that interbank borrowing is associated with lower level of risk taking. This is also supported by our chair, Murinde, and colleagues, 2016, who also found an inverse relationship between interbank activity and bank risk in Kenya. And I also did a study with a colleague, Triong, in 2019, and we focused on the feedback effects from interbank market volumes and rates to capital buffers. And we found that interbank discipline motivates banks to build capital buffers. This was for Malawi and Kenya. So as you can see, most of the studies, they concentrate on developed countries, of course, with a few studies on low-income countries, like the studies I've pointed out for Kenya, Uganda, Malawi, and Zambia, just a few in the region, in African region. But then even those studies that are done in developed nations, most of them do not account for the role of disciplining mechanism. They have talked about this mechanism without accounting for it. In other way, how credit rationing and pricing of interbank loans affect banks' ability to extend loans and pricing of loans. So this hasn't been talked about. We know that banks lend each other according to relationships they have. They discipline each other. We know that risk banks are charged highly. But what has this to do now with their intermediation role? Their ability to extend loans and pricing of loans. This is a bit silent in literature, or there's a serious gap. So we are also motivated by the need to distinguish the transmission mechanism of monetary policy between the policy instruments used by the central banks and how such instruments affect interbank markets, and then differentiate that from the link between now the interbank behavior and availability and pricing of loans. So this study aimed to investigate the role played by interbank discipline in the transmission mechanism of monetary policy. Of course, in the context of Malawi at the moment. And we are trying to answer two questions. The first one is, does a bank's dependency on the interbank market affect its loan supply to its customers? And the second one is, do the rates at which banks borrow from the interbank market in turn affect the price at which they lend to their customers? So to achieve that, I'm using data from which has been provided by the Reserve Bank of Malawi, and it's bank level and non-publicly available data for banks operating in Malawi from 2010 to 2018, and it's a quarterly data. And this is high quality data. Unlike other studies that have used estimates, this I'm using real data, which is non-publicly available, and it's first data, the data as it is. And this is high quality data. And I believe it will be, the study has potential to inform policy in low income countries, especially those countries which have similar issues of interbank markets like Malawi. And looking at the data, we observe significant differences in both growth in loan supply and loan rates offered by these banks to their customers. For growth in bank loans, you can see these are banks, about 8 banks here. You see that's how the provision of loans or supply of loans to their customers has moved over time. And the same is also observed in terms of differences in terms of lending rates among banks. So the question is, can these differences be explained by interbank market discipline issues? So to do that, first of all, we estimated the loan growth model, and we regressed loan growth to a number of variables with interbank dependency, the IBD as our main independent variable. And loan growth is measured as the natural log of the total loans outstanding in current period minus the natural log of total loans outstanding in the previous period. And interbank market dependence is the sum of interbank borrowings undertaken by a bank in a given period divided by the bank's total liabilities for the period. And guided by literature, we also included capital adequacy ratio, liquidity, bank size, loan provision, and a dummy variable for ownership called local, where 1, if a bank is a local bank, it's owned by local shareholders, or 0 otherwise. And also government taking the value of 1 if a bank is owned by the government and 0 otherwise. And we also included the monetary policy rate to see the impact of monetary policy on growth of loans, and also included inflation and the lag value of the loan growth. In order to see if lending rates are affected by interbank market rates, also we did this, we regress loan rate on IR, which is the change in interbank market rate, and capital adequacy ratio, liquidity, and interaction of interbank rate and capital, and also interaction of interbank rate and liquidity. And also added government and inflation and change in monetary policy rate. So how did we do that? How did we estimate the model? First of all, carried the F-test to see if we have to go by all areas or fixed effects, and fixed effects was favored in both aspects, and also do the Bruch-Pagan-Lagrange multiplier test to test to make the choice between all areas and random effects, and random effects was also favored. And now to decide between random effects and fixed effects, I carried out the Horstman test, and in both cases, random effects were favored. So both models, the loan growth model and the loan rate model, were estimated as random effects models. So what do we have as the result? For the loan growth model, we see that the coefficient of interbank dependence is highly significant, and it's positive as expected, implying that banks that depend on interbank market more are able to grow their loans faster than banks that do not depend on this market. And the coefficient of capital adequacy ratio is significant and negative, and we find that size is positive, meaning that the bigger the bank, the faster it is able to grow its loans. And for loan provision, we found a negative relationship, which means that riskier banks do not extend lots of loans to their customers. And we also found that the loan growth for local banks is smaller compared to foreign banks, and that government-owned banks do not grow their loans faster as compared to privately owned banks. And we find that tightening of monetary policy is associated with a slower growth in extended loans, and also found inflation to have a positive impact on growth of loans. And concerning the loan rate model, we find that the coefficient of a change in interbank market rate is positive and significant. And also found that the loan rate is affected by the interaction of interbank rate and capital adequacy. And we also find that change in monetary policy rate positively affect the loan rate. So what does this mean? This means that banks that rely more on interbank market for their liquidity needs are able to expand loans to their customers more than those with reduced reliance on the interbank market. This is also in support of what was found by Allen in 2014. And this result points towards the role of interbank market in the transmission mechanism of monetary policy through the bank lending channel. We also find that bigger banks facilitate higher loan growth than smaller banks, and that being a highly capitalized, a riskier bank, and a local bank and a government-owned bank hinder loan supply growth. We also find that tightening of monetary policy hinders loan growth, and that inflation facilitates loan supply growth. Now, in terms of the interbank market rates and loan rates, this implies that an increase in the interbank borrowing rate is associated with an increase in the loan rate. And the impact of increase in the interbank borrowing rate on banks' lending rate is reduced for banks with higher capital levels. This implies that this could imply that banks with higher capital levels would be less concerned about changes in the interbank market rate when pricing their loans. We also see that changes to the monetary policy rate act as a strong signal to banks, along with the more direct effect on the interbank market rate, in as far as it affects the costs of bank funds. This implies that although the impact of monetary policy tightening works through the interbank market, there is still a much stronger impact to the lending rates that comes directly from the monetary policy rate itself. So what do we conclude from this? We conclude that banks with access to the interbank market are able to expand credit to their customers faster than those with no access to this market, and that banks pass interbank borrowing costs to their customers when extending credit to them. And these imply that there is a presence of transmission mechanism in this market, both in terms of the supply and price. And also conclude that interbank market behavior can limit or intensify the impact of monetary policy. So the interbank market has the potential to determine the effectiveness of monetary policy, at least in as far as Malawi is concerned. Yeah, so in a nutshell, that is it. And as I said, it's still work in progress, and I will appreciate any comments. Thank you so much.
Okay, thank you, Esmie, for the interesting paper and for the thorough discussion of the issues. Covered all the elements of interbank markets in Malawi, and also on the implications of a monetary policy. So at this juncture, I'd like to call the discussant for this paper, whom I did mention at the start, but now that he's right here, I'd like to introduce him formally. And this is Dr. Michael Atingi, who is the Deputy Governor of Bank of Uganda. Dr. Atingi is a very accomplished researcher and also a very well resourced policymaker. Just to give first his credentials in terms of a researcher, that he did his postgraduate degrees at Cardiff Business School and Liverpool University, and spent some of the time writing, researching in the research department of Bank of Uganda. But for his previous work as a doctoral and postdoctoral researcher, I'm pleased to say that we have in the audience two people that who used to work closely with the Michael Atinge, and this is Professor Kent Matthews, who is in the audience at Cardiff University, and Professor Christopher Green, who is at Loughborough University. And thank you, gentlemen, for joining us as well. Dr. Mike Atinge has held very distinguished positions in the policymaking arena, nationally and regionally and globally. Globally, he was the deputy director at the International Monetary Fund in Washington for many, many years. And regionally, he was the recent executive director of MEFMI. MEFMI is the macroeconomics and financial management institute of Eastern and Southern Africa, based in Harare. And from there, and now transition to the deputy governor role at the Bank of Uganda. So we are very delighted to welcome you to this session, Michael. And please, you have the floor to make a comment on the work of Esmie Kanyumbu. Thank you, Michael.
Thank you very much, Victor. Thank you for inviting me to discuss this paper. And I'm very, very excited that you have with you Professor Kent Matthews and Professor Green. I owe these two professors a lot. They have done a lot for me when I was doing my postgrad studies in the United Kingdom. Thank you so much, Professor Kent Matthews and Professor Green, and also you, Professor Victor Murinde. I recall my lecturer when I was doing my postgrad at the Cardiff Business School. Thank you very much. Now, just before I get the ball rolling, I just want to make sure that we're discussing the same paper, because the paper that I got was to do with the network structure of the Malawi interbank market, implications for liquidity distribution and contagion around the banking system. Is that what we are at?
Yeah, I think my apology, there might be the prolific nature of Esmie Kanyumbu's papers coming up in this. Could be that that's one of the papers partially, but slightly changed here to address monetary policy. And my apologies. It's not Esmie's mistake. This mistake is mine, Michael. Yeah.
Okay, that's not a problem. I will then bring in the policy angle to that to see how I can kind of like cover what Esmie has discussed or has presented. So, so a very good afternoon to all of you. I guess the time in the UK is afternoon, so I'm correct to say a very good afternoon. And for those of you who are in different time zones and tuning in virtually, whatever it is, good morning, good afternoon, good evening. So first of all, I would like to thank Esmie for the inspired choice of the study of the Malawian interbank money market. I believe that this market is central to the transmission of monetary policy to the economy. And the paper that I write, it captures the structure of and operation of the Malawian interbank market vividly. So I take note of 4 key issues that this paper covers. It assesses the network structure of the interbank market to draw implications for the distribution of liquidity and the contagion in the banking system. And of course, in applying it to Malawi, it observed that the interbank market is small, active, able to distribute liquidity among players, and is resilient to the entry and exit of the banks. And like most of the low-income countries, the interbank markets are restricted to domestic banks and sometimes discount houses. And most of the trades are really overnight. And it's not surprising that the high connectedness exposes the interbank market to contagion risk from systematically important bank suffering and operational risk. And the problem that I had, it talked about the incomplete market structure. It talks about the clustering. It talks about the market centrality, which are all very key aspects in the conduct of monetary policy. So why does this paper matter to me? as a discussant. It matters not least because it delves into the efficiency and effectiveness of the wholesale liquidity intermediation, the safety and the soundness of the interbank market, as well as the market development, and of course, not to mention the implications for monetary policy transmission. And moreover, the lessons from this paper are relevant for PE economists, as revealed in their studies of the interbank markets in Kenya, Zambia, and Uganda, among the others. But some of the highlights that I took from this paper are that the Malawian interbank market, like in PE economies, is highly segmented, and it could exacerbate the potential credit crunch during a crisis. And of course, the dominance of class of the banks and the existence of bilateral credit limits among them makes liquidity expensive, forcing the dominant players to discount securities or resort the Lombard window for funding rather than using the interbank. And so this certainly calls for the development of the interbank market, to broaden it and deepen it, so that the entire financial markets, including the introduction of cheaper products such as derivatives in the FX swaps and forwards, together does the boosting of the smaller players' capacity to handle structured products. Now, the other issue is that the availability of central bank policies and facilities, or the stance of monetary policy, does of course affect the level of activity in the interbank, showing that the network theory that was discussed by Esmie could be leveraged to understand better and improve the role of financial intermediation in policy effectiveness. And then the existence of systematically important players in the interbank calls for a better analysis to underpin their impact on money markets and on the wider economy. And in my view, this would enable the central bank to closely monitor the systemic vulnerabilities and to develop policy measures to minimize the occurrence and the impact of contagion risk, and partly by enhancing resilience of the market players to idiosyncratic and exogenous shocks. Now, this, of course, has got to do with policies that you put in place to deal with the too big to fail banks, including extra capital requirements to match the risks and limits of proprietary trading. And we will get back to that later on. But let's look at the macroprudential policy, which I think should be implemented to supplement the macroprudential regulation to assess the risk to the financial system together with the system capacity to withstand shocks, given the interconnectedness or interlinkages among the participants. So why am I interested in discussing this paper? I'm interested in discussing this paper because it does reinforce the Bank of Uganda financial stability framework, which includes macroprudential surveillance, stress testing, and risk modeling, together with the prescribed capital buffers for domestic systematically important banks. And also the paper strengthens our resolve in pursuing active financial market reform and development agenda to give banks and investors the confidence to participate in local financial markets in a sound and transparent interbank money market. Now, accordingly, in Bank of Uganda, we have worked with different partners, including FrontClear, to develop the repo market through the Global Master Repurchase Agreement to enhance the horizontal repo trading and sell-back transactions. Why are we trying to reform this? We're trying to reform this because we've seen some shortcomings in the repo market, given the fact that the alliance that exist in the horizontal repo market, and therefore, in the event of insolvency of any participant in the horizontal repo market, it becomes difficult to settle that transaction. You have to join the long queue of the creditors, and you are not a priority in them. So we haven't seen much transactions in the repo market, compared to the emerging ones such as the FX swaps and forwards. So we believe that by working with the front clear, we will develop a global master repurchase agreement to enhance the horizontal repo trading and sell back transactions. Also, we'll be working with the International Swaps and Derivative Association, ISD Master Agreement for advancing the derivative trading. The Global Master Securities Lending Agreement will be important for securities lending. And we believe that if we enforce this, the development of the Uganda repo market will actually make the interbank much more active and therefore increase in the transmission of monetary policy to the broader economy. To touch on to some of the issues that Esmie was talking about, but I will try to focus on the on the lending that Esmie talked about, although it was not in the paper that I read. I just listened to it. But let me just conclude on this one. So, so this agenda is basically meant to work with Bloomberg and primary dealers on market pricing to generate a Bloomberg valuation curve, which we think is likely to facilitate the listing of the Uganda government bonds on the frontier and emerging fixed income indices. And we believe that this is going to promote interbank money market activities as well. So if I may just conclude on this paper to do with the interbank money markets, I think the paper that Esmie did is a very vital contribution to the understanding and development of the African financial markets, and it deserves to be widely read by all the central banks amongst others. So the potential of the interbank market for effectively transmitting monetary policy, in my view, is underexploited, partly because of the segmentation constraints, which leads to market inefficiencies and therefore stunted growth. And also we note that interbank market is a potential source for contagion risk, calling for greater attention to macroprudential surveillance, regulation, and extra measures for systematically important financial institutions. And on a last note, I believe that it's customary to suggest ways for improving research, papers such as this one, as well as to motivate further relevant research. So I'll offer a few thoughts on this. So Esmie, in the paper that you did, I think it would be important to have a simplified, or you could simplify it by introducing network diagrams to aid intuitive visualization. There are too many words there trying to describe too many things like centrality. You're describing the density, you're describing the connectedness in words, but you could actually have used diagrams to better explain that, because if you just use diagrams, it makes it easier to visualize what you're. So that when you talk about clustering, you talk about connectedness, you talk about completeness, it is much easily represented in a diagrammatic form than in words. And then I think you could also read the paper by having a fuller discussion of the policy measures that broaden and deepen the market, mindful of the safety and soundness. And then also you might want to contextualize, you might want to contextualize the prevailing monetary policy frameworks and explore the potential variations to completeness, clustering, and centrality, among others, under alternative monetary policy frameworks. This is vital in my view, because having seen Uganda progress from a monetary targeting regime to a successful inflation-like targeting regime, the way monetary policy has been conducted has kind of like changed the the structure of the interbank activity, because under a monetary targeting regime, you are endogenizing interest rates, and therefore you are going to have a lot of yo-yoing volatility in the interbank rates. So with this volatility in the interbank rate, the whole structure of your interbank and all the issues that you referred to are going to change. Now, when you move to an inflation-like targeting regime, you are more concerned about stabilizing the interbank rate within a given band the policy bands that are determined by the central bank, and therefore the aggregates, including liquidity, become endogenous. So that endogenizing the liquidity while trying to stabilize the interbank money market rates within a given band has implications for the discussion that you are having in the structure of the interbank. So it would be good to look at how the monetary policy framework affects that. And then also, it would be good to inform the generation of the results to peer countries, because these and future studies could further study the impact of central bank policy and operations on the interbank networks, as well as how these networks could be leveraged to monitor the effectiveness of central bank policies. But most importantly, the role of offshore investors in your money and securities market becomes very, very important, particularly if they are coming through the FX swaps and forwards. What we have seen in the case of Uganda is that the FX swaps and forwards have grown in multiples of the interbank, largely because these are secured products, which even a small bank can take part in. Therefore, the connectedness has kind of like increased. So maybe trying to understand how does the structure change when you change the monetary policy framework and when you allow for the development of the FX markets, such as the FX swaps and the forwards. It all has impact on that. But let me quickly touch on what you presented, which I didn't have. If you don't mind, just take me to the title of your presentation, and I talk of curve. Yeah. So you were saying that, sorry.
Are you able to see my screen?
Yes. No, okay.
Okay.
Yeah. Just go back. I'm not seeing the title now. You'd shown it before.
Yes, I'm sharing my screen now. It's the role of interbank markets in monetary policy transmission.
Yes, can you just, I'm not seeing the slide with the title because I just want to talk to that off curve.
Okay, I'm sharing it right now. I don't know what's happening.
Okay, it's not projecting. The title is what? The role of what?
The role of interbank markets in monetary policy transmission.
Okay. So let me try to link that to what I mentioned. So I think it depends on, it likely depends on the type of monetary policy framework you're having in place. Again, I'll try to use the experience of Uganda in that. If you're having a money targeting monetary policy framework, I want to believe that the capacity of the interbank money market to be a conduit for the transmission of monetary policy is kind of like constrained. Is constrained by the something I've already mentioned, that once you are targeting monetary aggregates, you are endogenizing interest rates. And therefore, your interest rates are going to be all over, all right? Because depending on the shocks that are hitting your economy, all right, it could be exogenous shocks, it could be extended shocks, and what have you. But if you, or real sector shocks, if you fix a monetary aggregate, there's no way your economy can adjust to these shocks except through the interest rates, the interbank money, and the interbank interest rates. And that volatility in the interest rates is not very good for the development of both your financial markets and for the real sector. So I want to believe that the interbank money market becomes much more effective in transmitting monetary policy if you're able to stabilize the interest rates in that market. So now, if you stabilize the interest rates in that, in those markets, then we can then begin to assess that whenever the central bank changes its policy rates, right, and the interbank rates are within the band, the policy band that have been described by the central bank, how is this transmitted to the real economy? The analysis now becomes much more clearer when you have stabilized the interest rate. So I'll then give you off curve. In the case of Uganda, when we move to inflation light targeting, we were able to stabilize the money market rates within the policy bands. And therefore, it's now possible to study what is happening to the lending rates, what is happening to the quantum of private sector borrowing, because you have stabilized that key variable. And what you see there is that it is asymmetrical. It is asymmetrical. Whenever the central bank changes the policy rates, and if the central bank is increasing the policy rates, you find that commercial banks are very fast in revising upwards their lending rates. But when the central bank wants to lower, or when the central bank lowers the policy rates, you don't get the same response in terms of the lending rates. So there's need to understand, why is that the case? Why is the response of this asymmetrical? It's something that we are trying to grapple with. But of course, if you also now look at to what extent can interbanks really transmit monetary policy, I think there are a number of structural factors which are constraining the capacity of the interbanks to transmit this. And these are non-monetary policy issues. These are mainly structural issues that have to be addressed through structural reforms in other sectors. And then, of course, the other one is you need to look at the role of government in this as well. Because if you look at government borrowing requirements that are domestically financed, you find that let's take the case of the post-COVID, the COVID-19 period, when the central bank wanted to increase liquidity to the private sector. So what did the central bank do? Most central banks lowered their policy rates. They opened liquidity windows that were meant to aid supervised financial institutions in accessing liquidity. So whereas the interest rates in the interbank money markets came down drastically, we did not see that translating into lower lending rates or increased lending to the private sector. Why was that the case? One, there's a risk averseness, all right? There are other factors that are playing in. You need to look at the environment that you're operating in. Under the COVID-19 environment, there was uncertainty about economic activity. And any prudent bank would take precautionary or would be risk averse in lending to the private sector in a situation where there's uncertainty. So no matter how much you have lowered your policy rates and they lowered the interbank rates as a result, no matter how much liquidity is available in the central bank for commercial banks to access to increase lending, as long as the commercial banks have taken that perspective that the level of riskiness out there is high, they will not respond to what is happening in the interbank, particularly through the interest rates. And then also, if you had serious economic activity, you would look at the financing of some of these activities through the interbank. So take, for example, if I am a commercial bank and the bulk of my liability structure is at the short end, and I am seeing that the demand for my assets, particularly through the private sector credit, is slightly on the longer end, it means I'm going to end up with a maturity mismatch. But if that maturity mismatch, the resultant interest rates from the maturity mismatch can enable me access liquidity in the interbank, I would certainly do it. So increased lending by commercial banks, even in a situation where they have a maturity mismatch with a functional interbank, can help finance longer term assets than the shorter term assets, provided the price is correct and there's completeness in the interbank and what have you. So it can help in that way if the if the interbank is complete. And then my final point on this would be, again, the situation of COVID-19. When the central bank lowered the policy rate and the interbank rates also came down, we didn't see increased lending to the private sector. Neither did the rates come down. And for one simple reason also. One, the government borrowing requirements increased substantially because the revenues were coming down. Expenditure needs to finance COVID-related expenditures were increasing. So the budget deficit also increased. So how did they finance it? It was through net domestic financing. And once you increase, on your net domestic financing, you are likely to affect the interest rates on the government securities, which are a risk-free instrument. So if the risk-free instrument, all right, is raised now rising much higher than the lowering of your policy rates, which is being reflected in the interbank. So there is a disconnect, all right, between transmitting to the real sector, because if I'm a bank, I'm going to price my lend to the the private sector on the risk-free instrument of the sector, and that is the government security, not really the interbank rate. They don't look at the interbank rate as a benchmark for pricing. They look at the risk-free instrument of a similar tenor. So there are some structural challenges which need to be addressed for the interbank to properly transmit monetary policy. And that have got to do with, first of all, the reform of the interbank itself. Like I told you, how do you reduce segmentation in the interbank? How do you ensure that the securities that have been used for borrowing or lending in the interbank can actually be trusted, that when the bank goes under, then I can still get this. How do you reduce segmentation in the interbank, right? And then how do you also ensure that the issues that you talked about, clustering, the issues of centrality, the issues of connectedness, the issues of completeness, all those issues have got to be addressed if the interbank market is to be a conduit for the transmission of monetary policy. So anyway, I'm sorry, I'm just talking off curve. I would have loved if I had this earlier on to give my thoughts. So Victor, I'll leave it there for now. And again, to thank Esmie for the presentation. Thank you.
Thank you very much, Michael, for the excellent discussion, and in particular giving an insight into the market in Uganda and what you are learning and how it relates to the issues that Esmie flagged up in the discussion, and also for being a real-time discussant of talking about the component of monetary policy. I very much appreciated, because that's the way in which the quantity clearing, the liquidity clearing, and also the price discovery, the interest rate setting in the market, of course, will have great implications for a monetary policy, both components of the monetary policy, the liquidity, and the prices or the interest rate. And I think you reflected on that, quite clearly and helpfully. I would like to also invite, before I open the floor for discussion, also to invite comments from Anosi, one of the rising stars, engaging with the complications of the interbank market. And if you could be brief, Anosi, that would be much appreciated, and we can open the floor for further discussion. Anosi?
Yep. Thank you very much, Professor Victor. Good afternoon to everyone. Thank you very much, Esmie, for the presentation. It was very interesting. I was a little bit surprised too as well. I mistakenly got the wrong paper. I had prepared some notes, but through your presentation, I also made some comments, and I'll try to merge the two together. I think it's very interesting, looking at how the interbank market or how monetary policy decisions affect pretty much the real sector through the interbank market. I think the results on loan growth or the model on loan growth I think I found very interesting that banks who are more dependent on the interbank market pretty much have a positive effect on loan growth. I think this is something that could possibly be investigated further. Why is that the case? If a bank is very much dependent on the interbank market, it may be that they are not financially they have some certain inherent. Is it perhaps a risk-taking behavior? Is it because more risky banks tend to take on more risk even in the general market? I think that's something that struck me. One of the things I'd like to speak generally to is interbank markets and systemic risk. One of the things that's highlighted in the paper that I went through was centrality measures, right? And how systematically banks who are at the core could be technically tagged as systematically important banks. Now, maybe a question more towards policymakers is, can this be integrated in stress testing models? Or how is this integrated in stress testing models that are being used regularly to stress test the banks and assess systemic risk? I think the scores, even measures like the Z score and the S score, perhaps could be augmented. Although they do take into consideration the interbank exposures, perhaps the network exposure, the network position could be incorporated that need to have affect classification of banks systematically important and those who aren't. Because quite interestingly, within the literature, in terms of banks that make up the core of the network, some studies have actually shown that it's not limited to the size of the bank, as characteristics of banks that make up the core. There has been evidence that small size or medium sized banks also tend to also creep up in the core. So I think that's an interesting dimension for research. Also too, in terms of monetary policy transmission, one could also examine how the monetary policy regime may affect the network structure of the interbank market, and that could also serve as a channel through which there's an effect of monetary policy through the interbank network and onto the real sector. So those are some comments that I had.
Thank you, Anosi, for making those important observations, comments, and some suggestions. Okay, now we open the discussion to the floor for comments, which could be research, could be policy, could be modeling, could be any aspect of the paper. Given that this is a work that is at attention. So I'll take in order in which they came up. First, Dr. Thomas Bwire, Dr. Jared Osolo, and Professor Kent Matthews. So let me start with you, Thomas.
Thank you so thank you so much, Victor, and also thank you, Esmie, for bringing up speed to this kind of environment in Malawi. But also I want to thank you, Victor, for Michael. He has been quite elaborate. And in the course of his discussion, I discovered that every comment I had been covered. And I may not have much information to add. But just to pick up from there, he raises a very fundamental question. I mean, a very fundamental inquiry, Esmie, which you need to consider. The kind of monetary policy framework on the basis of which you are analyzing this transmission mechanism. And I think his point, that becomes a concern in the sense that, you know, interbank rates are an operating monetary policy target for countries that are under the interest rate regimes. Now, in an environment like that one, now this goes to your model. So if we have the interbank rate being a monetary policy operating so it might present complications in terms of having the interbank rate as well as the measure of monetary policy within the same regression. Like he mentioned, you know, for a case, for example, when you look at the correlation between the interbank rate and the central bank rate, we had a number that is beyond 90%, although much of this is asymmetric. So if that happens to be the case, then we see a very big complication in terms of the information that we are picking from that particular regression. And I think you need to consider that. But of course, it depends on the regime in place. The other single important variable, which I think you may need to look at, is the level of economic activity, the level of aggregate demand, because loan demand ideally goes hand in hand with what the demand is in the economy. So GDP, I do feel that GDP is one of those variables that possibly you could have considered, including in this kind of regression. But also the other thing is, of course, I appreciate we are looking at this from, you are looking at from the aggregate level. But again, we find fundamental differences. This data is disaggregated at sector level, essentially arising from the fact that the interbank market has a lot of segmentation in that. So I don't know whether in the scope of this study, there can be any possibility that we can also look at this kind of loan demand and the response of, say, the average lending rates within a sector, if this is proportional to the kind of monetary policy that it could be prevailing at that material time. And to me, that would give us an additional layer of information in terms of the transmission of monetary policy into the real economy. Otherwise, it's very good work, and I think it contributes a lot to the kind of literature that we are looking at. Thank you, Victor.
Thank you indeed, Thomas, and for adding those very important observations, and also for having for being able to say how close your observations are to those of Michael. I think there are quite a number of central banks in the region who are indeed grappling with those issues. And that's why I'm very pleased to see in the audience that Grace Chokunda from the African Development Bank, who has an interest in this, has also joined us in this presentation. And let me also take the opportunity to mention a number of people who are keen on interbank market developments. I can see Majid Zien, I can see Joe Marie, I can see Peter Oroz, I can see Rogers Ochenge, and of course Joshua Abo, who's just published a coverage of this on Ghana. So I suppose this is strong network here. But let me now proceed and call upon Dr. Jared Osoro of the Kenya Bankers Association for his comments. Jared.
Yeah, thank you, Victor, and thanks, Esmie, for a very good paper. I think you heard a lot of this conversation, which is a very critical subject of interest to many of us. I have 3 comments which are related that you can consider here. The first one is the fact that you are assessing the transmission of monetary policy through the interbank market. You may need to have a clarity as to how you frame your argument on how monetary policy is transmitted. And if indeed monetary policy is transmitted through the credit market, then you ask yourself the question of what is the pricing mechanism for credit? And does the interbank market have a role in the pricing of credit? Being an overnight market, as you say, it has a very little bearing on the pricing of credit, considering that banks look at the cost of funding that may not necessarily be overnight. And that's where I think the line between monetary policy and transmitted is a bit disconnected. And I think that's something to think about. The second, and this is something that Mike also emphasized, is amplifying the aspect of the segmentation of the market. In an interbank market that is segmented, that is usually revealed when there is a shock. The interbank market is revealed more when there's a shock. And when there's a shock, the market actually ceases, especially for the lower tier banks. So the big banks, small bank dichotomy manifests itself in terms of liquidity flying to the big banks. In that case, the interbank rate actually doesn't have any information content because the smaller banks are not getting liquidity at whichever price. So that therefore means that you have to be very careful on how you frame your argument on how the interbank market behaves, especially when there's a shock. And the third, which is an interesting thing coming out of your result, is your observation that there's a link between those who are active in the interbank market and the rate of growth of credit in that segment. That may not necessarily be a causal effect. It could actually be a tactical behavior of the market players, where you find that those that are active in the interbank market, who are naturally bigger banks, will find themselves having a higher loan-to-deposit ratio, meaning that they're more aggressive. Those that are small and have limited access to the interbank market tend to be more conservative and therefore have a lower loan-to-deposit ratio because they are more or less trading profitability for liquidity. So that trade-off actually reveals itself in how credit grows in the various segments of the market. And if you have bank level data, you can actually be able to see that in your model and see how you can bring in the aspect of loan to deposits as it varies from one segment of the market to the other and how that reveals into the loan growth. But otherwise, this is a very interesting piece of work. Thank you.
Thank you very much, Jared. Very, very absolutely helpful comments. I will come back to you, Esmie, for the iteration later to, in case you want to respond to some of these. But I can see that some of these are comments, observations, rather than questions. But in the case questions arise, I note them here and you also note them. And then we can respond. But in the interest of the lineup of other colleagues, let's continue. And now we call upon Jeffrey Igedosa is another rising star at SOAS as a researcher. So Jeffrey.
Yeah, thank you, Victor. Thank you, Esmie, for your presentation. I find the topic very interesting. My comment is an addition to the point that Anosi and the last speaker raised about the link between interbank market participation and lending growth. I'm thinking whether that is has something to do with information asymmetry. I don't know if you've considered that as a variable or a way to extend your study. And I'm not sure how information asymmetry can be measured in the context of interbank market, but I think you can explore that in the form of opacity, because and also looking at it from that angle, you can actually measure opacity in terms of bank connectedness or their involvement in the interbank network. So I think you can measure opacity from there, and that will add a lot of angle to understanding that part of your findings. Thank you.
Yeah, thank you very much for those that brilliant suggestion of having symmetric confirmation, at least among the players in the interbank market, because that opacity may be priced, may lead to different, price distortions. Let me go now to Oladapo before going back to Kent. I was also going to suggest to Kent that you possibly come out and come in again, and that might be make it possible, and then you click on audio. Okay, so Oladapo, do you want to go ahead, Oladapo, and then I come back to Kent? Oladapo.
Okay. All right. Good afternoon, everybody. Esmie, thank you very much for the presentation. Quite insightful. But if we follow carefully the comments we've heard, especially from Jared and Michael today, it has been around the importance of systemic risk and financial stability in ensuring that the interbank market effectively transmits monetary policy to the real sector. So if you look at the model, I don't think there are variables that speak to that point. And I think that was what Jared was trying to say the other time when he said you can look at your loan to deposit ratio, which is basically a standard proxy for financial stability. And also, I think you can also look at probably an index for banking supervision, because when supervision is very efficient, then you have more effective transmission between interbank market and the real sector. And again, you can also look at risk averseness of the banks, which Michael was actually speaking to. So I think those are just my my suggestions, just to make your model more robust. Thank you very much.
Thank you, Oladapo, on the modeling bit of it, and that's very similar to the amount of work that you are focusing on. I think actually that issue also becomes absolutely important if, say, you were to compare Malawi with Kenya, because that's where the variations can be in terms of the bank regulation and bank supervision. Okay, so thank you very much. A very good point taken. Okay, so let me go back to Kent. Are you able to?
Well, I'm
excellent.
Can you hear me? Oh, you can hear me. Okay.
Yeah, I can hear you very well. Yeah, thank you very much.
Right. Well, thank you, Esmie, for an interesting subject, and I enjoyed it very much. I have one question and two comments. I mean, my question is really one of confusion. I'm sure whether you were looking at two models, one on the loan growth and one on the loan rate, because if there are two models, then you'll have to explain to me why you're looking at two models, because if that's one model, then I'd expect to see the right-hand side variables on both equations to be common. They'll be the same, rather than having a mishmash of the differences. The other thing is the points made, and to address the point that Michael made, and good to hear your voice, Michael, although I didn't get to see you. I don't know if you're still here, but the point about endogeneity, I think Michael was making was absolutely correct. But that endogeneity also goes between the bank and the interbank market, because one of the things you said at the beginning was that safer banks or well-capitalized banks can borrow cheap. Okay, so that obviously means there's that endogeneity there, that the interbank market is pricing that risk in. And I just wondered how you dealt with that in your modeling. And a final comment, Michael raised the point about, the interesting issue is why interest rates rise quickly but fall slowly, for the banks in response to monetary policy shocks. Well, he suggested that they look at it from a contextual point of view. You look at it in the context of COVID-19. But I recall actually a theoretical paper by Chris Green written a long time ago that looks at this in the context of an SS strategy, where banks do this anyway. that they always raise interest rates fast and lower them slowly. So maybe Chris might remind me what that paper was about, but I think that there's something there that you could look at. Okay.
Thank you very much, Kent, for those the question and the two comments. Actually, your question is very critically important as it enables just clarification, the focus on the key endogenous variable in those two models. I will ask Esmie to come back to this later, and I can also add my observations the way I see the specification of the models mentioned. Okay, now I have a question now by Richard. Yes, Richard, please go ahead.
Thank you, Victor, although mine was the most recent hand to go up, but never mind. A question to both Esmie and Michael, as I'm less familiar with the banking sectors of Malawi and Uganda, and that is, you talked about Esmie, you talked about government-owned and non-government-owned banks, and I wondered how large the government-owned banking sector in Malawi is. In some countries, it's quite large. In others, it's quite small. And linking it, and you similarly, Michael, in Uganda, but linking that into the issue that Kent was just talking about, picking up on Michael's point, one of the headaches that we went through, certainly in the UK, during the 2007 to 9 financial crisis, which might recur now, is that the central bank and the government that influences the central bank really wants banks to lend to the private sector in order to contribute to reboosting the economy after a downturn. And so the central bank lowers interest rates as a way in order to enable banks to borrow cheaply, with the idea that the banks will then have more liquidity to lend out, and the banks don't do it. Now, in the 2007 to 9 crisis, the answer was that the banks saw recapitalization as a life raft. They say, you know, if you give us cheap money, okay, that's a lifeboat. I'm not about to jump out of the lifeboat to give it to someone else. And my perception is that in the West, in Western Europe, in the global North, we have not solved that problem. And I wondered what the perspectives of Esmie and Michael were from a central and Southern African perspective. Are you any further to solving that problem?
Thank you. Very good question, Richard. And I'll give an opportunity to Esmie to respond. But before I do so, I will take only one comment from the floor, and then I come back to Esmie. So Esmie, please hold your fire. I'll come back to you in 1 minute. I'll just now take a comment from Adan Shibia. Adan.
Thank you, Prof. Thank you, Prof. Mine is just very brief. It's about the time frame for the data. I saw it was from 2010 Q1 to 2018 Q4. If this is an ongoing work, and the author being an insider to the bank, I would have expected to extend that data a bit, even if maybe if we avoid 2020, maybe up to end of 2019. So I just wanted clarity why that time frame. Thank you.
Yeah, thank you very much, Adam. That's for that helpful observation. In a way, most of these comments, Esmie, have already extended your paper and provoked another paper, and knowing how prolific you are, that won't take a long time. People were commenting and adding ideas on issues like COVID-19, monetary policy within and after COVID, some of those. But there are some questions which came up, especially the question by Kent, and then the question by Richard. So let me give you a couple of minutes to respond briefly.
Thank you so much, Professor Murinde. The question about why two models from Professor Kent. I was trying to look at the supply part of it. If banks have access to the interbank markets, are they that help for them to extend more loans to customers? That was the one aspect of the transmission mechanism. And I'm also looking at the pricing aspects. If banks are charged highly on the interbank market, do they also charge heavily when extending the loans? So that's why we had the two equations. One, looking at the supply growth, the ability of banks to extend loans to their customers. And secondly, looking at the pricing itself. So that's why we came up with two aspects of the transmission mechanism. And concerning the data, why 2010 to 2018? I agree. This is I can get data up to 2020, but the reason is because when at the time I was starting this project, this was the latest data I had. I started these things in 2018, so I need to extend, yes, but that means I also have to work forward and backward throughout. So, but this is possible, very possible. I can extend and redo it. Yeah. Thank you so much. And okay, can I go on with the comments?
Yes, please go ahead. Yeah.
Yes. Thank you, Dr. Michael and Tingi. I hope I have pronounced it rightly. The Deputy Governor from Uganda. It was exciting to see you, and you have brought in a number of issues, and you have helped me to think and rethink, of course. Most of the issues you have talked about for Uganda market are very similar to the Malawi market. And one of the points that I've picked, one of the most important points, is that we can't look at interbank markets as a separate market, but we have to look at it in terms of what is happening in other markets, like the government treasury bill market, the government bond market, and everything. That's a very crucial point, because whatever is happening on the interbank market also affects other markets, and whatever is also happening in other markets affect this market. And I think going forward, I will bring in that aspect. And talking about the structural challenges, I think I agree with you. As a fellow central banker, all I can say is that we have a lot of work to do, and we can hold hands. We have a lot of work to do on the ground, and I think there isn't enough time for this seminar, and I think we can talk even outside this seminar. This can be a starting point to see how we can work to improve on such issues in our markets. But generally, the issues are the same. Yes, and Professor Kent, you have also talked about endogeneity issues. I do agree that that's true. And as I said, it's still work in progress, and I'm still trying to add and try this and that will be brought into that. And Dr. Bwire, you talked about the aggregate demand component. What about including GDP? That is something that I'm also doing, but I didn't bring it here at the moment because I'm still trying it. I have the data. I've got it. Of course, it's annual data, but I had to do it to bring it to quarterly data. So I totally agree. That's also important. In terms of I don't know, somebody has asked Richard, how large is the government sector? For the period of study that I've used 2010 to 2018, we had some 2 government-owned banks. And in terms of how big they were, in terms of assets, I don't have the figures at the moment, but that's something I can do. But at the moment, because of those problems you have pointed out, that these banks were associated with a lot of inefficiencies. So the government decided to sell them out. So currently we don't have government-owned banks. But for that period I was starting, I included that maybe to capture that component as well. Yes, about systemic risk and financial stability, looking at loan deposit ratio, I think this is also something I can do. It's doable. The data I have, I'll go back and check and see how I can bring in that component. And index for bank supervision, that's another way of looking at it. And thank you for pointing that out. So generally I say these are very constructive comments, and I'll go back and rethink and implement. I may contact maybe some of you on a one-to-one basis and maybe continue the discussion, but generally I appreciate their very good contributions. Thank you.
Thank you very much, Esmie, for detailed responses to the comments and discussion, also on the questions being raised. I think I can see a hand up from Dr. Michael Atinge. I suppose, yeah, that must be a new hand. Yes. Okay, so I'll take quick comments from you, Michael. Please, you have the floor.
Thank you so much, Victor. I am just responding to the question raised by Richard, a very interesting question. What do you do when the central bank does all it can to encourage commercial banks to lend to the private sector, but the commercial banks are kind of like not doing so? I think correctly sometimes the commercial banks undertake a risk assessment, and given on their risk assessment, they may find that it's not really worthwhile lending to the private sector, notwithstanding availability of credit. So what have some governments done? So if you take the Western, the advanced economic governments, you have this whole concept of quantitative easing. Quantitative easing comes because the available monetary policy tools fail to transmit the the objectives that are intended. They're intended for. So you lower the rates, you increase access of central bank liquidity to commercial banks, but commercial banks are not, lend to the private sector. So what does the central bank do? They begin purchasing bonds from the private sector, right, just to add liquidity to the system, because the private sector cannot get the credit from the commercial banks. Now, try to translate that into emerging economies, into low-income countries. No, the size of the central bank balance sheet is so limited, and there are quite a number of risks that are involved. So trying to think of quantitative easing in the context of central banks in low-income countries is not visible, largely because of that. First of all, we don't have strong private sector that has issued bonds that are really credible and can be counted. So it is difficult. So we have to rely on fiscal policy in that situation to see how government can prop up the private sector in times when banks are not lending, particularly during the slowdown. So you have to use some counter-cyclical policies through the fiscal policy. Thank you, Victor.
Yeah, thank you, indeed, Michael, for those additional and helpful observations, especially about the rigidities in the structure of the market in the countries we are talking about, and how there is a way of going about, the process, very timely. We are getting close to the end of the session. And I don't see any information in the chat that requires some answers. or any hand going up? Meng, can you see any hand up or any questions? No?
No.
Oh, okay, thank you. So what remains for me is to say thank you to all of you. But before I do that, let me make one observation on the presentation by Esmie, the discussions from the discussant, especially Michael, Anosi, Thomas, and the question that came from the floor, which were helpful. What we see here is great characterization of the interbank market in Malawi. And it's a good we had a mix of those whole papers, because there are other additional papers that Esmie has produced alone and jointly with other researchers. But we also get very good coverage of the market in Uganda, and also the market in Kenya. I think the comments from Dr. Jared Osoro, who is the head of research in Kenya Bank Association, was very helpful. And we know that there is also a work that is going on in Zambia, and I think as Dr. Andrew Mwawa is aware, and other researchers there. What we see now, and the question I just put before you, is that understanding the country-specific nature of the interbank market is important. But as we move closer, the next step is that we try to see how the markets in the region could be interlinked, and not only in terms of policy, but also in terms of the connectivity of their platforms. And perhaps, that's where that's an area that we're gonna go into moving forward. I just become a little bit futuristic and ambitious in terms of pushing the frontiers. Of course, there is greater work remaining for work on countries like Tanzania, for countries like on Rwanda. South Sudan is a new case, but it could be incorporated. If we look in the entire interest of the Eastern and Southern African region, and I think that's why I was excited to see Maji joining in the discussion, and other people who have been involved in legislation, like Joe Marie in the audience, has been very critical in very important, very important in helping on the regulatory angle, and especially getting the voice from these countries. So there is a kind of a great aspect, but apart from that, in terms of the way we go forward, let me thank you, Esmie, for your continued work in this area, and for being able to excite our interest and share your research with us. Let me also again thank the discussants, and thank all of you who have been able to join us today. I think Esmie's last words were very helpful. He says the discussion continues where outside the forum. That's absolutely correct. And before I go, so let me acknowledge Machiko, who's been a great mentor in this respect of work. And I saw Machiko in the audience some time back. So, thank you very much. This was very great session with a great fellowship, and with the which has opened the frontiers of work in this area that extends the research, and also the great need for policy. And that's why this session had the great interaction between researchers and policymakers, and involve some of the people who are both researchers as well as policymakers. So thank you all. We look forward to the sessions next week, and we'll continue to send you blurbs and invitations as we go forward. So again, thank you indeed, and have a nice afternoon or evening, depending on which neck of the woods or location on the world you are in. Thank you indeed, and bye-bye.